Hello, Culture Matters podcast. I'm so excited for this episode with my co-host here, Aleck Arena, the Value Investing Series. Before I introduce our guest, here is a quote just for this episode. Every man takes the limits of his own field of vision for the limits of the world. Arthur Schopenhauer. Our guest today, an accomplished investor, decades of experience, background in engineering, almost worked on robots at one time and ended up helping people develop their lives through their wealth, is the founder of Pella Funds International investment firm. Jordan Cvetanovski, friends of our co-hosts, network of amazing people. And I love what you're doing, Jordan, and to learn more about long-term orientation and sustainability and how that actually crosses over with investing. I think that'll be very enlightening for our listeners, entrepreneurs and up-and-comers and investors for the future. So thanks for coming on the Culture Matters podcast, and thanks for making this happen, Aleck.
Good. We're gonna ask them.
Well, first, I'm curious about how one is influenced from a PhD in robotics to analyzing small businesses in a
Right.
yeah, that stuck out.
Yeah, that's a good question. Look, I never did my PhD. I was about to do my PhD in robotics. So I was actually studying engineering and economics at university, and I really enjoyed my time with the engineering side of things, working on an autonomous underwater robot. So
Wow.
autonomous robots and things like that are a big thing now, but we've been looking at that for some time, and engineers around the world have been looking at this problem for a while now. And with the advent of AI, or I should say the advances in AI, a lot of things will become very possible in many aspects of our lives, but we can get into that a bit later. So how I got into it, I mean, I never, many investors come on your show and I'm sure they say, look, I read a Buffett book or I read a Soros book or something and inspired me to do this and that. I was never one of those guys. I basically finished university, and back when I finished, the dot-com was just about starting, and it was popular for firms, financial firms, to hire from engineering schools investors, basically people they thought could become investors. So the way it came about was I was very late to all my applications for the various places around, because I thought, well, I'm just going to stay and become an academic. But BT, which is former Bankers Trust, kind of sent me a letter, and I spoke to them. I said, I'm late with my application, but here it is. You let me know what you think. And they said, we like it. Why don't you come over to Sydney and have a chat to us? And we had a chat. They told me, a few things, what it was all about. They said, we think you would be a good equity analyst, and here I am 25 years later. Yeah.
What was it about engineering minds or content or academic that these businesses were looking to recruit from? What is it about the engineer's mind that makes sense for?
Yeah, it's an excellent question, and I really think they were onto something, because I think in engineering what you really learn is to approach problems from first principles. And by that I mean, if you don't understand the basics, the building blocks of the solution, or how you're trying to solve something, then you will tend to think, well, I used this solution last time, it'll apply to this kind of problem, then this. Whereas in engineering, you just say, what are the fundamentals? What do I understand? And how can I apply it across many problems? And I think that problem-solving ability, and ability to kind of separate a more complex issue into several kind of digestible pieces, is what I think makes engineers quite suitable to the job. And I found that in several instances throughout my career. So yeah, I think it's very well suited to analyzing companies and markets and economies, because when you manage a global fund, don't forget, you're not just looking at a particular company, because nothing is in isolation of itself. Everything is connected, and there are a litany of kind of problems interwoven, and you have to be able to kind of separate and think what is important for what I'm trying to achieve and what is not. And half of the job is about ignoring things, and half of the job is about accepting the things that matter. So I think having an engineering mind really helps in that respect. And I also did it's a systems engineering course where I did a lot of mechanical engineering, chemical and computer engineering. So I was able to span across different kind of fields of science, which really obviously helps when you're investing in markets.
Why is it important to ignore things?
It's important to ignore things because we're bombarded with information and we're bombarded with opinions. Everyone seems to have an opinion these days. And if you don't have, there needs to be an anchor point. There needs to be a place that you call home in what you're really looking for. So at Pella, we often say, what are we looking for? What's the type of company we're looking for? What's the type of portfolio we want to build? What are the characteristics of that fund? We think of the portfolio as one company with 30 divisions rather than a portfolio of best ideas. So then we can approach things in a way that we can say that isn't important and this is important, because for the long term, only 3 or 4 things matter. The rest of the things are just either details that don't matter or just noise. So half the battle is understanding and honing in on what really matters with a company, with a situation for an economy. And that is the toughest part of my job, I would say.
Early on, when you were analyzing equities, what did that look like? Did you wake up at 4 a.m. and get in a cold plunge and then go and look at?
Look, I did the old, and this is not a popular thing to say, but now, because of all the, we are a little bit more aware of how to treat staff and things like that. But I used to work very late nights when I first started. There was a lot of 2, 3 a.m. pizzas and analyzing a lot of different companies when I first started. And actually, my first job was doing technology in the middle of .com, right? And my first experience in markets was a collapse and that was foundational in my beliefs that I took with me for the rest of my career. In fact, what I learned from those times. So how it started was, the first thing was figuring out what the whole thing is about, and that took me a while. I had to learn from all the different. I worked in a company that had 40, 50 analysts. They all had silos in different sectors and all these kind of things, which I would personally is not my favorite way of approaching things. And I'll explain a bit later why it doesn't work for me. But I got to really speak to a lot of people and learn a lot of things, and also learn good things and certain things that didn't suit me. So that was the first kind of couple of years. So I went from, they were very growth focused, very, doing DCFs, and I'll get to valuations, which I think is very important. But and what I realized back then, and as an engineer, and I was looking at these DCF models and all the reports, and I realized very early on that the whole thing can be easily gamified, and you could basically make anything attractive or unattractive, because there's so much. It's like the integral of a very long tail. So if you adjust a little bit the terminal growth rate or anything like that, or the WACC or whatever, it can all lead to very different conclusions. And it's, in engineering terms, we say if there's a sensor, for example, that has a slight error, and you for a robot figuring out where it is, if you add it over time, that error becomes bigger and bigger over time. So it never made sense to me. Then I went to a place that was more value contrarian place, so entirely different tack, if you like, and approach. And I thought, okay, there's other ways of making money. And very early on, I realized there's many, many ways to skin a cat, and no one's right and no one's wrong. Whatever works, worked. But that was an interesting time, and I suppose I learned a lot from that period when I was in a hedge fund that was a more contrarian value. The idea there was that in order to be making money, you have to be away from the crowd, and you have to be basically, there has to be an arbitrage, and an easy way to gain an arbitrage is to assume that everyone's negative on something. So your job was to come up with a positive and identify the 1 in 100 case where you are right. The problem, I mean, fundamentally that can make sense, but the problem with that is very often there's many people looking at the same thing, and very often it's easier to identify something that is bad than something that is good. And very often they are right about the bad things, and you often get caught up in certain situations. You dig in, you end up thinking you're better, you're smarter than the others in a certain situation, and you might just get stuck in a trap. And then I went to Europe, where I thought I need to meet these companies that I'm analyzing, because it was all theoretical for me. So I needed to see the machines, I needed to see the management teams, I needed to learn. And so I packed my bags and went to Europe and worked in both the Netherlands. I started in the Netherlands, where I did a small mid-cap product that was really good. And that was about $1 billion under management. And that was, I think, the best way to learn how to invest for people starting out in the industry, I would say, is to look at small, medium-sized companies, because with these smaller companies, there's less levers to pull for the management team. So you can analyze 1 or 2 things that matter to the business. They're in smaller markets, they're in smaller niches, and they have smaller number of competitors. And I think that's where you learn what makes a good business, what can go wrong, and how often the management tells you things you want to hear, and how often they tell you things that you should be hearing. So that was a really good experience, I would say. But my formative years, I think, really in my career really started when I moved to Paris and I joined a fund that was approximately 2-3 billion under management, kind of private family-run firm, which successfully grew to about 55 billion euros under management while I was there for the 6-7 years that I was in Paris, where I managed, I managed some European funds, emerging market funds. I went through the GFC during that period, and there was a lot of things that can be said about that period. But why that was important is that's when I was given some funds to manage. And the task was, we don't have a house style. You do what you do, but do it right. You get it wrong, you're out. So the best thing I could think of doing was first to put all my life savings into the fund. And I thought, okay, step number 1. Step number 2 is, how would I like this fund to be managed myself? So a few thoughts came into that process. One was, as I said before, entering into this industry, I found that it was laden with jargon and a lot of things that kind of only made sense to the person that was really using it in a certain way, but it didn't make sense across the board. So I found that some people were using, for example, price to book or PEs for a certain kind of company in a certain stock, in a certain industry. Then they would use a DCF in another one. Then they would use price to sales for a fast growing tech company. But I thought, how do you know that that price to sales one that you just bought is cheap relative to something else in another industry, or as good as something else that you've got in the portfolio, like a tech company versus a healthcare company versus an industrial business in Europe? I had to find a common language. I had to know, I had to be able to tell people that we bought company A, even though it's in tech, because it's actually better than company B in healthcare because of this metric. And the one metric that made sense to me was free cash flow yields. And I found back then there was a lot of scandals from an accounting point of view as well. You had Enron, you had this, you had that, but cash flow generally can't be faked. And there's the least amount of errors that can go into free cash flow, analyzing a cash flow statement. So I decided to focus on cash flow as my basic valuation metric. That was point number 1. The second, so that was that's something that I've taken with me all the way through 20 years later. That's never changed. So through thick and thin, we've stuck to that basic principle. The second thing I decided was that I want to be investing in companies that are winning. And by that, and a good measure for that is growth. Stop me if you like with any
No, this
question
is great.
if
Yeah, yeah.
I'm going too much.
I'm writing them
So,
down.
okay. So look, some people buy value investors, and Aleck is here, and he'll give you a different take on this, I'm sure. I think it's too hard. Look, life's hard enough to invest in companies, full stop, because you don't have the full information. You don't, and if you're going against the crowd, if you're going against the grain, and it's a company that's in trouble and it's going through a turnaround, these are very, very difficult things to get right. But what is easier to get right is identifying a company that has been doing well for some time, has been gaining market share, has been improving their margins over time, which means the management team is doing something right. Because when you think about it, our clients go to their advisor, they need to trust them. The advisor then goes to many funds and picks out the funds that they trust. Then we get their money. Then we have to go out and find a company with a management team and a business model that we trust. There's about 4 layers of trust here, right? So you have to be able to trust the management team. And one of the ways we do that is to look at their track record and what they've done and what the business has done in the past. So good management team is important, but also a company that has been growing. If you think about it, guys, it's much more fun working for a business that's growing than one that's you turn up to the office and they keep telling you that they're cutting costs and they're firing people. So it attracts better people to work for them. So that's what we're looking for. So growing businesses is the only thing we invest in. And then we go to a lot of potential clients and they say, well, what are you? Are you a growth manager? Are you a value manager? What are you? And we say we only invest in growth businesses. That's true. But that doesn't make us a growth investor in the general sense of the term, because we're so focused on valuation. So that's the second thing that we do. And then it's getting more technical, which we probably shouldn't get into. But the other thing that I did was I didn't want to be the type of fund that does well in only certain market conditions. So a growth fund won't invest in mining companies. And the question is why? You can make money many different ways. So the way I did it was to say, okay, let's make sure that 60 to 80% gives us a stability. So invest in solid businesses that give you that 5 to 15% growth. They've done it over time. They're cheap. They're the right valuation. And that immediately gives you the solid foundation to go out and explore and do something else. 0 to 30%, we say we invest in cyclicals. Why not? When you time the cycle right, you can get 3 to 7 years of a good cycle and these companies can grow. An example of that was emerging markets, for example, when China was booming. That was a cycle, but it was a cycle you should have invested in mining. There's certain mini cycle, banks for us are cyclical, interest rates and those kind of things. Emerging markets generally are cyclical. So when you time it, there you have to be a little bit contrarian. You have to pick, you might want to look for a signal, but you can invest in that. So we invest in that. So we're a growth manager, but invest in cyclical businesses. And finally, we do invest in faster growing tech companies, but again, they have to be backed with cash flow, and we treat them with a lot of respect. We treat the risk that comes with it with a lot of respect. So we have things like stop losses and position sizing that's a lot smaller. So this combination of companies allows us to invest across the board in different cycles. If it's a cycle that's driven by technology, we can participate to a certain extent, but we make gains elsewhere as well. If it's a market that switches into fiscal stimulus, which we might get over the next 3 years, we'll make money out of that through industrials and mining companies and those kind of companies. So it just allows us to participate across cycles, and that means that we can stick with the market over time. So that was Paris, and then moved to Australia due to family reasons. I had 2 boys. Yeah.
How much, if at all, did living in a new country and on the other side of the world, Paris versus it was Australia, right?
Yeah.
How much did that influence you're investing, if at all?
Well, a
Like
lot, I
living
would
in
say. I
that
mean,
culture, did that
yeah,
impact
uh,
how you
I
viewed the
think we,
world at all?
yeah, I think my wife and I did the maths, and I think I was out 4 months a year traveling and meeting companies. So
Wow.
I
Wow.
was I was not in the office 4 months a year meeting companies, and that would include everything from what is topical: Russia, Ukraine, Middle East, Africa, Asia, but across Europe, I would have visited almost every company. And it was very important to join those dots. So we talked about what is important, what is not. And the more companies you meet, the more you kind of, the more you're able to compartmentalize information and think this is important for that company. Oh, I should look at that company. So it was important to be on the ground in order to learn. Um, Whether being in Europe or US would have been any different, I'm sure if I was I think there are subtle differences. I think Europeans are a little bit less, um, my experience, kind of enamored by the blinking lights on the Bloomberg, and they do think a little bit longer term. From my but I also think there's some extremely, I mean, it's the center of the universe when it comes to investing is the US. So there's some excellent investors there. So I don't think it would have mattered if I spent time in US or Europe. It was just good being on the ground meeting companies.
What do you
Yeah.
get when you're there in on the ground meeting the company? How is that
Well, yeah,
influencing intel or due diligence?
yeah. Uh, I think I think again, what I don't do is more important than what I did. What I don't do is talk about what's happening this quarter or what's happening next quarter or whatever. I spend the first half of the meeting focusing on where they've come from, why they got to where they are, and what's been happening recently. Um, then I try to understand their competition, and they'll tell me a story. Then I'll try and meet the competition, and they'll tell me their story.
Wow.
And they're different stories. I can tell you that much. The final thing is, I mean, the final thing is really kind of asking the right questions and really trying to not waste their time. You know, I think management teams respond to good questions. So yeah, my dog is scratching at the door at the moment. um,
What's their name?
the, Billy Bob. It's got a double name. It's a little cavoodle, so you wouldn't believe it, but it's a cute dog with a Billy Bob name. But he wants to get in, so I have to ignore him a little bit.
Yeah,
But
you want to let them in,
yeah,
it's fine. Yeah, it's culture.
no, it's all good. It's all good. It's all good. So yeah, so that was very important, I think. But now, the older I get, and I've got a team of 4 or 5 analysts with me at the moment. They do a lot of the legwork, if the groundwork, and they meet with the companies. I make sure that every portfolio position we have, I participate in at least one call a year with them, and understand everything that everything that I need to understand. Yes, I read the analyst reports. Yes, we discuss them all as a team, and we debate things. But I always like to be involved, even now, as a fund
Hmm.
manager.
Debate. What's your philosophy around
Yeah,
discussing ideas as a team?
yeah. So
How to do that effectively even?
yeah, I've worked in teams, and where you have collaborative. Several people have to say yes to something. I find that sometimes you just have to back one person, and we have to go with that when it comes to the final decision. But the journey can be different. And the way we do things is, for example, an analyst or I come up with an idea that we should look at. The analyst writes an initial report where we all scrutinize, and I say, yep, that sounds good, keep going. And then the deeper insights come out a month later, 2 months, depending on the complexity of the company. Hopefully not too complex, because I really dislike complex investment cases. It has to come down to 2 or 3 things. And
Hmm.
then during that discussion, we encourage constructive criticism of things if you can. When I say criticism, it's more, have you thought about this? Have we looked at this or that? Whatever. And then the analyst just says, you know what? you're right, I'll look at it, and then come back with the answers, then we'll discuss them again. So it's really collaborative. What really helps us is that we have this common language, the way we look at free cash flow, the way we value companies, the type of things we look for in a company, we all understand. We've worked together for 10 years now, and we have this understanding. So it really helps. There's sometimes I worry, should I add some disruptor to the team just to shake things up, which is something I might do at some point if I feel like there's too much of a group think. But I don't believe there is, because we're very sober and clear-headed about what we're looking for.
Just on the Aleck, go ahead, please. I'm getting excited.
Great formative years. So were you at Bankers Trust in the late 90s?
No, it was when it was taken over by, was it Principal Financial? So Deutsche Bank had them, and then Principal took them, I think, and that's when I came in.
Okay,
it was 2000s, I think it was.
Okay, I was going to ask about the early 2000s and the whole .com boom bust, and what were the valuation? Were they just doing extreme discounted cash flows? Is that how they were valuing them, or was it like price to sales in an extreme version, and you were kind of cutting your teeth in the industry, and they were doing the weirdest valuation models of all time? And then did that lead you to free cash flow usually doesn't lie, and because it's kind of a more, that feels to me like it's a more engineering take.
It wasn't, free cash flow appeals to me because it really makes sense. For example, when we invest, if you look at the portfolio now, what we say, we talk to investors and we say, if you just look at the cash that's been spun out of these companies on aggregate in 10 years time, if they grow at a pretty, the pace that, we think they'll grow at minus something, you'll get at least 70% of your cash back in cash. In 12 years time, you get all of your cash back. That means you own the companies for free after that, 12, 13 years time. And that kind of makes sense to me. It makes sense to you. It makes sense to anyone. But for me to say the DCF says it's got 26% upside at this stage, here are the assumptions. It was difficult because those assumptions can vary from stock to stock, to industry, and that was a bit difficult. And that was in vogue at the time, everywhere, and people still use it. And during the dot-com days, I mean, there was some madness going on in the markets. The way people valued companies, and I think there was a sign of that in 2021 as well. For the first time since that period, about 3-4 years ago, I thought, hey, this feels like .com again. When all those medium-sized tech companies were just incredible valuations, eye-watering. And in some ways, you look at Palantir and Tesla. In some ways, you could argue that maybe some of it hasn't left us, and there's still believers out there. But we can't make those valuations work, and we don't see how you could. So that was. .com was that on steroids. Basically, every single stock was like that. Yeah. And you're right. I shunned that away. I said, there's no way I can invest money, because that's not investing. That's second guessing. That's speculating. That's gambling. That's hoping that someone would buy the stock off you at an even higher price. But there's no foundational.
Do you often have to follow winners for some time because of mispricing opportunities or something of that nature?
You mean, would we have to buy something even though we didn't kind of agree with the valuation?
Going to the winner component of your.
Oh, okay, yeah.
Your right, like it could be an incorrect inference. Like a winner, might be, more people involved in it. So are you like following it a longer period of time to find a mispricing to come in at the right price?
Yeah. I'll give you two examples of that. Just after the GFC, there's two stocks that I bought that were the top positions in my funds. One was ASML and the other one was Novo Nordisk. Now, Novo Nordisk, interestingly, back then when I bought it, was in 17 times earnings and the most expensive company in Europe. On a PE basis, if we look at PEs. On a free cash flow basis, it was a different story. But the point of that was the growth was much more sustainable, and the growth in we don't have enough time to go into how we look at stocks, but we look at the combination of growth and the free cash flow. That's what gives us the returns over time, and that's what makes a company good or bad. Now, the case with Novo Nordisk, when I bought it, back then they just released Victoza, I remember, and we held it. So I've held it ever since. So what is that? Since 2008 or 9, whenever the GFC was, until now. So 15 years. And that's gone up 60-fold. And it's always been, it was one of those good companies that kept going. Another one, and I was never tempted to sell. In fact, we've got it now. We're still not tempted to sell because we believe the market's not focused on the right stuff at the moment. They're focused on trial data that misses by 1% or 2% on how much weight loss, whether they make 22 or 23% weight loss. We think it's an industrial game going forward. It's about how much of it you can produce at what pace. And if you're spending a lot of money on CapEx over the last 5 years, you will be able to supply the demand. That's very high. The second one I bought is ASML. When I bought it was 10, 11 times earnings. Just after the GFC, and it was about 11 euros or 12 euros. Now it's 600-700 euros. Now, I've held that ever since, and that was a winner, if you like, and a winner that I saw being a winner for the next 30 years. Why? Because they had 100%, officially they would never say they had 100% market share, but they had 100% market share in making lithography machines. And I realized that very simply, without those machines, we don't have technology progress. We don't have Moore's law. We don't have the iPhone. We don't have NVIDIA. We don't have anything. So if that was to disappear tomorrow, GDP would drop by 0.5% globally, I would say. We would have to go back to the iPhone 7 eventually. There would be no progress in leading edge chips. In order to grow the use of chips in everyday life, we need them to keep inventing and making these machines. They practically broke the laws of physics to make the EUV machine. So clever guys, 100% market share, crucial to the planet, and no one can surpass them. When I summed up the CapEx that they've been spending over the 5-10 years prior to me investing, compared it to any potential competitor, and it was basically 20-fold or 30-fold. And I thought, no one's catching up to them, not for the next 20 years. So that was a winner that you keep no matter what. Now, if I have sold it down and bought it back up, like you suggest, when it gets overly expensive, we sell it down and we buy it back. But in the end, I'm very positive on the longer term profile. Sometimes, and we have a big watch list of companies. One is Intuitive Surgical, which makes robots for surgery. It's in the US. Very good business. We monitored that for 4 years. It was way too expensive. Then the sell-off in growth happened in 2022. I think the shares fell 50-60%, and it hit our price target. And you can see how value conscious we are, how far below what that thing was trading at the time was. And then we have the courage and the ability to back ourselves to buy these companies. And I think in March 2020, during COVID, luckily we had quite a bit of cash going into COVID. We avoided a lot of the collapse not luckily, but we sold down a lot when we saw the first signs in China. We sold down, the markets collapsed, and then we bought, I think, a record for my career, I think 12 or 13 companies in 1 month during that period of March 2020. No, when was it? March 2020, I think.
March 2020.
Yeah.
Your work was done beforehand, correct? Like you'd already met with all the companies, because a lot of people try to do it themselves. It's very hard to explain. They're just buying it on a wind of something else, where you're doing the work, going to meet the management teams, waiting for your share prices to meet your targets, and then you're buying in at your price, which is your way you think intrinsic value makes sense, if that makes.
Exactly right. We've already written the reports. We already have it in our database as something we would love to own at some stage. And if you're patient enough, you will get a chance. There's always something. But the question is, will you pull the trigger and buy it? And in order to do that, you need a solid foundation of valuation and what you're looking for, and then be brave enough to make a bet. Something I learned from an old boss of mine, which I think is extremely important that I tell my analysts, is in this game, you need two things. I won't use the words that he used, but he said you need bravery and brains. You can't just be smart. You also need to be brave and make the right call at the right time. And when you do see an opportunity, you can not go all in, but you can invest with conviction. And that's how, if you're an active manager, you need to invest with conviction when you see an opportunity like that. Or it's very difficult to beat an index that is driven by passive flows and 7 stocks. So yeah.
I'm lucky that's not my job. AMSL, when you first
ASML.
when you first had the meeting with him, what were your takeaways, like straight away when you pretty much worked out they had 100% of the market share in early 2000s? Were you optimistically very excited? Can you just touch on that?
I was, and what made me really excited. So at the time when I spoke to my colleagues, they said, "Oh, ASML, notoriously these tech, these equipment companies are notoriously cyclical, and it should trade like a cyclical, like an industrial business, 10, 11 times earnings, whatever they used to say at the time." So I said, well, I think you're missing the point here. Can we all agree that technology will be a thing over the next 20 to 30 years? Yes. Then this is one of the most important companies on the planet. And as long as we need more transistors, more chips out there in order to facilitate this technological boom, we will need more of these machines. And we don't think I didn't think technology was a cycle. I think it was well and truly on its way. And then when I realized how innovative they are, how important they are, and how difficult it would be for some very competent competitive companies like Intel and the Japanese companies to catch up with them, I realized that this was a gimme. And you don't get them often, but it felt really, really right. And now it didn't feel good because it was a GFC and the world was going to hell. But in the end, again, if you're a long-term investor, you have to imagine what the world would look like 5 years from now, not what the world looks like today. And you think, if technology is a thing 5 years from now, then these guys will be a much bigger company.
Do you think it influences your ability to decide or have that bravery, the background in fundamentals, like first principles? Like, you think at some level psychologically that influences the confidence to make a decision of the future, because you have such a strong rooting in reality, in a sense.
Yes, our approach is extremely common sense, and when you get question marks, when I start to question things, is, let's say you underperform, and every fund manager underperforms. If you think you can do this job and not go through a period of underperformance because of whatever happens, sometimes, Tesla goes up 100%, you can't participate. That's the end of that conversation. But when you're underperforming, you ask yourself, are we doing anything wrong? And when you think about it, our expected returns, the way we look at valuation, we say we expect to make whatever the risk-free rate is out there, 4%, we add 5% equity risk premium. We say we want to make 9% plus. Now, if the market makes 20, we might make 18 or 22. But we have to cover the base for our clients and make sure we've got a good alternative to other asset classes. And then we look at the fund. We say, is the fund cheaper than the market? So we look at free cash flow yield, not P's, not this, not that. Are we producing more cash divided by what we're paying for these businesses right now? Yes. Are we growing faster than the market? And there we look at the top line. So we say, is the revenue growing faster? Not earnings, not all these things that can be manipulated. Revenue. Are they selling more of their product next year than this year? Yes. So we're faster growing, cheaper. The third thing is, are we higher quality than the market? Why is that important? Well, it's important because you want to be able to get to your end destination. And how do you get that? You get there by backing high quality businesses. There we look at, are the margins higher than the market? Return on capital, is it higher than the market? All these factors we look at. ESG, I know people, there's a big backlash on ESG, but ESG is actually a measure of risk in many ways. It's about
I want to tap into that.
Yeah, how companies really manage their long-term risks, and that is superior to the market. So you put all those things together and you look at the constitution of the fund of 30 companies. Are we more diversified than the market? Well, we saw 2 months ago, for example, the US was 70% of the benchmark. Technology was 40% of the total world. And we said, look, if what happened last year and the year before happens the next 2 years, the US will be 85% of the world, and technology will be 50%. Does that really make sense? It's not even diversified. So we are more diversified. So you just go back to basics, all those common sense things. If you have those right, you just say, let's just sit on this. We've got good companies, we've got good valuations. We'll get to the other side and we'll do well.
Risk. For those that are listening, that are not even familiar with what ESG means, how can you describe that to the lay entrepreneur that hears news clippings? And then if you can go deeper on that topic as it relates to actually finding value. You mentioned long-term orientation, and your website really articulates it well, but we could speak to that.
On our website, we look, ESG has become it's become a label that's all-encompassing, but there's so many different things so many different ways you can approach responsible investing, and we've written a whole thing on this, and there's a presentation on our website for those interested. But ESG in its own right, it's not about necessarily, I feel in many cases in the US and other places, they think ESG is about saving the planet or doing good or something like that. It's actually about managing risks. And I'll give you an example. It's a copper miner in Chile that has a solid policy on water usage, so that, one, they don't get into trouble with the authorities, but also two, they don't run out of the resource that they need for mining. So if they have the right systems in place, they get a good ESG rating for that, and then they have less risk in the long term. So it's about managing those risks in the long term. A company that has good policy in terms of paying their staff and looking after the staff won't have strikes and things like that in the long term. So very often it's not entirely about, it can become about, oh, you don't have this policy or that policy. And sometimes you can get a little bit, caught up in all the details. But in the end, it's more about, does a company have one eye on the long term and managing those risks? That's how we see it. A company with bad ESG just basically has low regard for certain things that might come to bite them in the future. And the ones that don't, that focus on ESG, tend to have a longer term horizon. Now, we are not an impact fund. I repeat, I think that's close to impossible to achieve in public markets. We're not here to only invest in companies. We're here to make money. Let's not get this wrong. We are here to beat the market. We're here to do it with less volatility. We want the financial aims to be there. But what we're all about is we want to do it in a way that doesn't harm people, society, or the planet. And we think it's possible. We've done it in the past, and we think we can do it in the future. And I think this is how we should all invest.
Is part of how you're looking at it is an accountability mechanism?
Yes. Yeah, that's a good way of putting it.
Like, what's the function of a board is a form of accountability, but even a board can become bureaucratic and reactive and regressive. I'm just trying to conceptualize it's like a meta view of an organization. Are they thinking, are they self-aware or whatever?
Are they self-aware? Yes. Are they just plowing through and not without any regard to the consequences of their actions in the future? that is what we're looking at. But sometimes we do have our ethical filter. Visa, for example, was a company we wrote about, we used to own, and we sold it. I'll give you an example. There's other examples, but this one we talked about, they facilitated payments on Pornhub. There was evidence that there was some wrong things happening on that website. We wrote to the board. Others have written to the board. They've never taken it up, and we just felt that they haven't taken it seriously enough. So we sold the stocks because we never felt comfortable. We've looked elsewhere and we've made money elsewhere. We just don't need to be involved in situations that we think the company doesn't take seriously, that matter to us. And we've listed all the things that matter to us.
How's that impacted your company culture and the culture you have with your company to your investors? To be clear on what you don't.
Yeah, I think I'll go back to what you said before, which is responsibility and taking ownership. The reason we set up Pella is because we wanted to set up a business that does make money and grow clients' wealth, but also does it in a responsible fashion. I was of the firm belief that you can't do that as part of a bigger organization. There needs to be direct ownership. So our company is held by the staff, myself and the employees, so it's privately owned. The second thing is we invest alongside our clients. So all my external money invested in markets is invested in the fund, as is our staff, the analysts and the distribution people. So we have this as a policy. So we feel the pain and the joy of going through the journey. The third thing is to follow these principles of responsible investing. It needs to come through the whole business. So we are a B corporation. We just recently got that classification. We also give back to the community once a quarter. We as a team go out and spend a day in a charity or something like that. Just, I think it's important to feel that there's many aspects and the culture is important. And so I think the way we approach it is a more holistic kind of way of doing it.
Yeah, I liked on your website where you were articulating what you don't invest in. Oftentimes, it was reminiscent of me to that Munger quote I was telling Alex before we recorded. Invert, always invert. Oftentimes, a company might put their core values on their website, but implicit in you saying all the things you don't support, it showed me what your values are. I liked it. It seemed like it was. I've never seen that before, but I thought it was very. It was interesting. There's something there that's very interesting. It's like, this is what we don't invest in. So that's reflecting what you stand for.
And look, we come across clients that say, why don't you also add X, Y, Z to the list? And we just say, look, that list can be endless. If we just said, this is what matters to us, and we think this covers a lot of things that we think are harmful to the planet and society and people, and we avoid them. We don't give those companies capital, but we allocate capital to other companies, and that's how we want to approach it.
I wanted to ask this earlier because I was thinking when you were talking about what was it, Nordic?
Nova Nordisk. They make Ozempic. Have you heard of
Nova?
Ozempic?
Oh yeah,
Nordisk.
the weight loss.
Yeah, weight loss. Yeah. So they discovered that drug, and then Eli Lilly came in, and now there's a few.
I was thinking, like, how do you stay humble? Because I feel like if I was at a checkout buying groceries, I might tell the cashier how I got a 60 return. How do you stay humble? You know what I'm saying? I wanted to ask that earlier. How do you keep a level head in this business with those types of risks that you're taking?
I get humbled. I get humbled by the market every week. It's a really, really difficult market to beat, and it's you have to stay on top of it. You have to be learning. You have to be curious. You have to be always looking. And there's not once has that idea crossed my mind, because I can also tell you about stocks that I've really messed up with, and that was a learning opportunity. So for every one that you see that you get a great return, there's others that you're not proud of. So the trick is over time is to learn from those mistakes and to also learn from the good things as well, and just to make more good decisions than bad decisions. But we're always going to get a couple of things wrong. That's part of the game.
How many names sorry, Aleck, one last thing. How many names or businesses are you looking at in a year? Is is it hundreds? Is it thousands? Is it dozen? That's what I'm trying to conceptualize that.
Yeah.
And how much work does it take?
Look, it takes, I'd say the analysts write about 10 reports a year each, and there's 4 analysts, so that's about 40 reports that make it through, and we really like it. Out of those, maybe we buy 8 or 9 of them, and the rest stay, what we call a watch list. And then we keep building that over time, that knowledge. So, but we look at many other companies that maybe after 3 days of looking at it, we say, hey, this isn't good enough. And this isn't for us at the moment, or we'll move on to something else. And that's where I think experience comes in. We're all very experienced investors, so we can say, hey, after 3 days, we know the 3 positives, the 3 negatives. We can kind of figure out this isn't for us and just move on to the next thing. And we might miss out on something, but that's just how we do it.
Aleck?
I was gonna ask about portfolio management. So you quickly touched on that before, and just the listener wouldn't really understand at the moment. So you touched on stop losses. Why do you have stop losses, and what do you have stop losses for in the portfolio?
So we don't have stop losses for our core, which I mentioned was 60 to 80% of the fund. We have stop losses for cyclical and innovation. Let's say you buy a fertilizer company. I'm picking some cyclical business, and the cycle's done this, and you think you're at the bottom, things are stabilizing. When we buy a core business, we focus on the management, the history, everything we can analyze, the sustainable growth trajectory. But when it comes to cyclicals, 50% of your decision comes from analyzing the cycle, which is something all-encompassing, and 50% is about the company itself. So there's a lot more out of the company's hands, if you like. Their future is reliant on something else happening somewhere else. And for us, that's another degree of uncertainty. So when we analyze the cycle and we get it wrong, and we can get it wrong, we don't like following the thing down. So for cyclicals, it makes sense for us to get to put in a stop loss. And we say if we lose 25% of a running high, we exit the position or minimize it and then redo the whole investment case and see if we want to stay in it. Minimize it to below 1%, because let's just do a whole new report. Same with fast-growing tech companies. We have stop losses. Why? Because let's say they're growing 30%. Now, for a company growing 30%, it's great, but they tend to be much more expensive because of the growth. And if they go 28% or 27% instead of 30%, the stocks can fall precipitously. So we also don't want to be involved in those situations either. And it's very difficult how do you argue, yes, they grew 30, now they're growing 27%, but they'll grow 33% the year after. It's very difficult to analyze. So when we get them right, it's wonderful. If we get them wrong, we'd like to move on to the next thing. It's just a matter of avoiding analysts falling in love with names after they've lost money. It's just discipline. There should be
Jordan,
something else in reserve. Yeah.
Yeah, I was just going to ask you another question, because you touched on judging management teams and obviously getting out and meeting them. But let's say I was working for you and we're researching a new position. Would you want me to go back and look at the annual reports and judge management on the previous 12 years and check the board, like what their corporate career, where it's taken them? Or would that just be meeting a management team straight away?
No. Annual reports are paramount. They're super important for us. All the truth comes from those annual reports. We don't rely on what the market thinks. We rely on what we think has happened over time. And the only way you can get that is by having getting all the annual reports, reading them, seeing what they've said, what they've done, what the conditions have been, and whether and assess them on that. So yes, we very much rely on official reports coming out of the company, and we read a lot of industry reports to judge it further. So absolutely. Meeting the company itself, I've got to say, if the bigger the company is, I found the less value you get from meeting the company, because what you get is basically what you can read about somewhere else. And there's less value in that. But then again, there's a lot of information on big companies, so you can assess things better just by sitting on a desk. And that's why, being in Australia, people ask me when we market in Europe and other places, how can you do it from Australia? I think we absolutely can. One is we're away from all the noise. We wake up when the markets are closing. We go to bed when the markets are opening. So we can sit and have a clear head and just read things rather than follow the news. And the second thing is, all the information we'll ever need is there in front of us in the form of annual reports and official and a bit of experience, that, and a clear structure on what we're looking for.
So is it?
Yeah.
Or go ahead, Aleck.
I was going to say, it's more effectively, so the listeners understand, it's more effectively a research house, and you're doing research in the companies and you're trying to stay unemotional. Then you're obviously not staying up at night and watching the share prices, or early in the morning and you're just going to sleep. And it's more like the structure of what I would call a research company.
Some days I sleep less well than other days, but I don't stay up to look at the market. Going into bed, seeing Trump has just put on 50% tariffs or something will not make me rest easy. But again, we would have thought about that possibility, and we would have appropriately adjusted the portfolio for that situation. But no, I don't see any value in trading and intraday trading. But a lot of people do, and a lot of people are very successful at it. It's just not our DNA. That's all.
Do you think in the journey of investment early in the career, there's the travel, the meeting with management, the getting in, almost like instantiated in the businesses is part of the ontology of the investor? Like, once you do that for long enough, you get to a certain point where you can read those balance sheets, you can read those quarterly reports, you can look at the corporation. Corporation is completely different than tribe. Tribe is a small little business, maybe founder or family owned. So if you could elaborate on that in closing, because we could.
Look, I'm sure the US is more difficult to govern than Luxembourg, right? So the more things that are going on, the more difficult it is. And but if you've met 1,000 Luxembourgs in different places, you can kind of imagine. And if the big country was split up into divisions that have 100 Luxembourgs, you could quickly understand what they're about. So a big pharma company that does products for cardiology and dentistry, for example, I would have met a company that does just dentistry, just cardiology. I would understand what they're all about. So there's those cases, but I agree with you. If I didn't have that experience, I wouldn't be able to do this job and the job that I'm doing now. So having met all those companies in the past does allow me and my team to put things into perspective much quicker than if we hadn't done that. So yes, that is very important for us. That is another ingredient that is key. Yeah.
It's been an honor to have you on. I feel like we got a master class on in just the beginning. You're always welcome back. This is great. I challenge the listeners to go check out pellafunds.com. So
pellafunds.com, yes.
Yeah, and go read about the organization and what you stand for and what you're up to. And thank you so much for coming on. This is you're always welcome back.
Thank you so much. Thank you. It was a pleasure. It was fun.
Thanks, Jordan.
Thank you, Aleck. Thank you, Jay.
Please share this with someone that has interest in investing that if you're listening. Leave us a review in the Culture Matters podcast. Go check out Jordan, and we will see you next time on the Culture Matters podcast. Thanks, Aleck. Thanks, Jordan.